Good afternoon, everyone, and welcome to Jumpstart's monthly expert-led webinar. Today, with a talented duo from Founder Shield on the 5 SaaS risks every founder should know and how to beat them. I'm Patty, and I'm the Senior Director of Small Business Services here at Jumpstart. Jumpstart offers the webinar series on a different topic every month, along with a variety of other educational programs and events. So make sure to visit our website to explore some of the additional offerings that we have and learn more on how you can improve your companies. Before we get started, a couple of housekeeping rules for today. The presentation is going to be between 60 to 90 minutes with time set aside for Q&A. So in your toolbar, you should be able to see an important communication tool where you can actually access the chat and pose your questions. So our partners are going to monitor the chat, and so are we. So we definitely want to hear from you if you have any questions for the panelists today. And then the second thing is that at the end of today's session, we will follow up with a link to a survey. So please make sure to participate in that and let us know your feedback about today's sessions and any other topics you'd like to hear in the future. And with that, without any further ado, I'd really want to introduce you to today's panelist. So Founder Shield is a risk management partner for rapidly evolving, high-growing companies. Their mission is to create the most seamless, intuitive, and responsive experience for purchasing and administering insurance for your company. They pride themselves in making the insurance process tech-enabled, custom-built, and lightning fast. We've got two experts in the industry from their team, Josh Butchness and Cole Spencer. Cole Spencer is a tenured member of the client advisory and brokerage team at the company, and he guides founders on a holistic risk management practice from seed to exit stage. Cole specializes in financial institutions, defense, SaaS, and biotech industry verticals. With 8 years in the startup game, Josh leverages his expertise at Founder Shields as head of partnership scout at Sweeter Ventures, and a mentor at Entrepreneurship for All to empower the next generation of entrepreneurs. I'm really delighted to have them both here today, and I'm going to turn it over to you. And again, please make sure to put any questions you may have in the chat.
Patty, thank you so much for the introduction. We're excited to be here today, and I hope to make it more conversational. If you have questions, please feel free to post those in the chat. We'll get to those, and we have a couple stopping points for questions as well. We want to make sure that this is something that's really helpful to you all and something that you can utilize on your journey as a founder. So I think we'll go ahead and kick things off here. Are you guys sharing, or am I sharing that? Sorry.
It will be you guys.
Okay.
You're in
Thank
full
you.
control.
Perfect. All right. How we doing?
Perfect. We can see your screen.
Looking
Thank
great.
you so much. All right. So today's webinar is 5 risks every founder should know and how to beat them. So not only do we want to kind of explain to you all, what some of these coverages are that you're very likely to see in the start of your journey, but also, how you can position yourself best to succeed. So our mission, as Patty had said, we wanted to create a seamless, intuitive experience. I don't know how many of you have had insurance experiences so far, but it can be a bit of an antiquated industry. You may be asked to fax things, which I'm amazed that we still do. But we put everything onto a tech platform. We made our questions easy to understand. And then from the insurance side, we're trying to build out insurance packages that benefit you? How can we put different policies together that make sense, especially for SaaS? It's very easy to kind of create like a bundle of things that you'll need in order to create cost savings or just kind of ease the process for you all. We also have really strong market access, so we have a lot of relationships, um, with different carriers, different specialty carriers. These are going to be outside of your normal, maybe State Farm or Nationwide or things like that. The people that we have access to, and we're also familiar with startups, and we're able to leverage that knowledge to really explain to these carriers what you're doing so they can fully understand what that risk looks like. You also get a dedicated advisor. So even though we're an insure tech company, you're still working with someone like Cole, who's really going to, take you through the process, help you understand, what are the difference in these coverages? Why is, this one $50 more than this one? What do these things mean? When should I be getting insurance? When should I be waiting? He's one of the best, and I'm super excited to have him on this call. So we'll transition into the agenda. So we just talked a little bit about Founder Shield. We're going to go into kind of like a risk 101, where we're just kind of, giving you guys an overview of some coverages that you're likely to need. And then we're going to dive into a couple of the coverages that may be not as straightforward, to give you a little bit more of a background and kind of give you some expectations of, hey, when someone asks me for this, now I know what it is, I know what it does, and even kind of the leverage to push back on people and say, hey, you're asking me for $5 million worth of coverage, but that's not really applicable to me. So we hope that we can kind of empower you on this risk journey that you'll be on. And of course, we'll take any questions that you all have. So our expert that we have with us, he's got a brief introduction. I want to dive in a little bit more, but he's a tenured member of our team. Cole, thank you so much for being here. I'm going to kind of play the role of founder and poke and prod and get some real life questions out of you, but he takes a holistic approach with his clients, whether they're, in the seed stage, whether they're, going to IPO. I really appreciate, the way that he brings his background with defense, and also working on the carrier side with Chubb, to really kind of set clients up for success. You've worked with larger Fortune 500 companies, so I think, what that does is it helps you really just bring a broad approach to someone that's in an early stage, as well as people are growing, and how they can kind of build something that'll be sustainable into the future. Again, I think we mentioned earlier, but he specializes in defense, as well as SaaS companies, biotech companies, and financial institutions. All right, so we kind of break risk down into three different buckets. Cole, physical exposures, employee exposures, and professional exposures. Could you kind of dive in and give a little bit of explanation about, how we kind of characterize these and why they fall into the buckets that they do?
Absolutely. And yeah, thanks so much again for the introduction, Josh. Glad to be joining everybody today. Yeah, in terms of, echoing what you just said there, Josh, in terms of the three main buckets that we break down commercial liability coverages kind of into. Obviously, that first one, you've got kind of the physical, what we would call property and casualty, in the sense of, you're thinking on-site risks here, whether it's property damage arising out of your operations, i.e. a client's software, product, monitors temperature and moisture content in a room, and then it triggers, sprinklers, damaging property, or a robotic arm, in a warehouse swinging around because of the software going haywire and damaging its surroundings, or, obviously on the casualty side of that, as opposed to damaging property, if someone was injured as a result and there's bodily injury, whether it's to clients, we usually call that the slip, trip, fall kind of bucket. So that's that first, physical, section that you mentioned, or physical bucket. The second of which is, you mentioned that employee. So I would call that the internal operating liability side of things. So think about it in the sense of like managing a team, such as workers' comp benefits for any employees injured on the job, crime, which obviously protects, a company from any dishonest acts of employees. Obviously, when building your team, usually for, when you just get up and running, it's a pretty tight knit group, and everyone gets along pretty well. But as soon as you start, kind of that journey to scale and start bringing in, outside individuals, and of course you can only do so much diligence during an interview process, but of course if later on down the line, someone is cutting fraudulent checks or sending fraudulent wire transfers or something that results in theft from either you or your clients, obviously that's that commercial crime coverage, which we would consider an internal operating liability. And then lastly, employee practices liability, which again, think of it as kind of an internal protection for the management team from any claims, arising from employees for potential like discrimination or harassment. I'm sure we can all think of a few scandals we've heard of that tarnish kind of the names of executives in the news and things like that. There seems to be a new one every week. So obviously, as a lot of the founding teams we work with start that journey to scale, obviously there is some concern that as they grow the team, they want to make sure that they're protected if they pass over someone for a promotion or a raise, or putting them in charge of a new team, if someone feels they were better suited for the role and they file suit because of some alleged discriminatory practice or something like that, or a hiring or firing decision was made. Obviously, companies need to kind of change tact at a moment's notice, and so occasionally, if it's to kind of safeguard the business and safeguard runway, so that the company can actually continue operating, and they need to say sayonara to a few employees who, no matter how valued they might have been at the time, obviously if there's a pivot coming, it occasionally happens. And so that's where those hiring and firing decisions as well can fall under employment practices liability, which kind of rounds out that second bucket of employee exposures. And then lastly, touching on the third bucket here of professional liabilities. Think of this more as your actual core operational coverages, right? Financial harm resulting to your clients, kind of arising out of your actions, for the agreed upon professional services that you were obligated to provide them. So we'll focus mainly on these kind of today, as they are considered like I said, core operating coverages, or exposures for clients in the SaaS industry vertical, as obviously there's generally very little on-site exposure. When it comes to the SaaS industry vertical, there might be a co-working space or an office space or something like that, or a trade show or conference, but there's not usually a whole lot of, on-site exposure, where some of our manufacturing clients obviously have a lot of on-site third-party exposure, where they have third parties or customers or clients coming to visit, warehouses and things where there could be quite a large potential for actual injury or damage to others' property. So that being said, we can definitely focus on these professional liabilities ones today, and then. And then lastly, touching on that internal employee exposure. Of course, we can walk through those today as well. But again, when companies are just getting up and running and still working, to scale from an early stage, it will kind of vary from client to client on whether or not how relevant that is at any point in their journey.
Yeah, and these are kind of just like a good optical guideline that kind of helps people see. Just because you are in the SaaS doesn't mean that you won't need a general liability policy.
Exactly.
These are kind of just general buckets to help everybody kind of visualize where these type of policies fall. So now let's move into some key situations. So I'm gonna poke you, Cole, and I just signed a contract with WeWork. Now WeWork must have a general liability policy. Why are they asking me to get coverage as well? What is it that what is it that I need to cover that they aren't getting covered already?
Yep, it makes and this is if I'm being honest, one of the most common requests from early stage clients, as they again, it could be two fully remote founders, or a founding team that kind of is finally starting to bring a team on site and needs to sign a their first ever lease, whether it's with an actual commercial office space for their own office, or if it's for a co-working space like something like WeWork. So, like I said, it's one of the most common impetuses we see for clients needing kind of the GL coverage, trigger. And the first, scenario is usually that landlord requirement, which is, you know, they're saying, hey, for any of your on-site exposures, your on-site operations, if you injure anyone on site, or if you damage the space that you are renting from us, obviously we want to know that you have coverage for any kind of on-site incidents that occur. And then similarly, kind of to piggyback off of the WeWork example. Another example, that we see clients a lot of times reach out to us and say, "Hey, I'm getting this contract requirement for general liability," is actually vendor and client requirements. So it might be a vendor or a client that you're working to secure a contract with, and they're saying, "Hey, we are going to require you to provide evidence that coverage is in place for any kind of bodily injury or property damage that arises during the course of our engagement together." And again, this usually comes up um, in tandem with another request known as an additional insured request. And whatever client or vendor you're working with is usually going to say, hey, I also want to be included as an additional insured under your policy. And all that really means is that if they are looped into a lawsuit pertaining to an incident that arises out of your actions as the company, that they're protected under the policy as well. It's not a separate policy for them. It's the same policy. You're just adding them as kind of a line item, additional insured under it, saying that, hey, if for whatever reason, WeWork gets looped into a suit as well because something occurred on site, because it was my fault, my insurance policy is going to pick up coverage for it. And as a result, obviously WeWork will be defended, think of it as like a co-defendant clause, an additional insured clause under that policy. So if WeWork had done something wrong, obviously in the burden of fault or liability sat with WeWork, of course it would, be under their general liability policy, as opposed to whatever company is acting as their tenant.
Okay, thanks. And just to kind of, I think you touched on it, but if I sign a contract with a big vendor, so that I'm signing with Chase, and now I'm seeing general liability, cyber insurance, and E&O. What I guess what is the purpose of Chase asking me to have the general liability piece of this?
It's a great question, because I mean, generally speaking, you're going to say, okay, well, even if most of the services we're providing, you, especially in the, in this SaaS industry vertical, are, software related in nature, there's not any on-site, any actual on-site exposures. Maybe there's, an occasional on-site visit or something like that. The thing is when it comes to actual, bodily injury resulting, you think, okay, well, from a software perspective, how is someone going to get injured as a result of this, right? And so it's one of those catch-all. It's also known as commercial general liability or business owners coverage. It is just the first and foremost kind of catch-all policy that if it's the duty to defend an insured under a potential claim arises, a general liability policy is going to step up to help incur any of those business income, business interruption losses, as well as any kind of damage to property, or as a result of, let's say, like I said earlier, if something happens with the software and it results in a back end property damage over at Chase or something like that, using that something like that, robotic arm swinging around example, something like that. Again, usually that's where these general liability policies just step up as that kind of catch-all business liability.
I have a friend, and I asked him about this one time, and for better or worse, the way he described it to me was, I need to know that this is a valid business that we're partnering with. And
Exactly.
he said it doesn't cost a lot of money, but it helps us know that they're running a valid business, and we feel safe working with that partner, moving forward.
Exactly.
Um,
It's one of those things that it's like, okay, well, an underwriter has actually looked at this and underwritten the business and valued the business to, or deemed the business to be, valid enough to actually offer them, $1 million in limits, 2 million in limits, whatever it might be. And so, okay, if an underwriter is willing to put their stamp of approval on it of being a, valid business, then it's okay, someone to partner with. Obviously that kind of underwriting as part of a vendor agreement has already been done, so the vendor, like Chase, can kind of rest easy or kind of take a breath knowing that whoever they're engaging with obviously has already been vetted and backed by another carrier with a much stronger, larger balance sheet, someone like Chubb, or using other examples like AIG, or some of the larger ones you hear in the news.
And Cole, could you just give us like a general kind of benchmark of, what someone in the SaaS could kind of expect to pay, just to help folks, kind of understand that a little bit?
Yeah, of course. And I mean, like all the policy, all of the different coverages we'll talk about today, it kind of comes down to a few main factors when it comes to pricing. Obviously, the limit that you need, because if it's just the industry standard, $1 million per occurrence and 2 million in the aggregate, then you're going to see a premium, for most SaaS clients in the realm of like $600 to $1,000 annually. However, if you need something like a $10 million coverage tower for general liability, obviously that'll scale in terms of premium. And so I usually put an asterisk and say, here's what the floor is in terms of that, bare minimum, million or industry standard $1 million per occurrence, 2 million aggregate threshold being around the, $600 to $1,000 mark. But again, it can scale from there pretty quickly depending on the requirements.
Yeah, and so in insurance, sometimes I have to pay everything up front. Can you talk a little bit about, from a payment side of things, can I pay $50 or $100 a month, or do I have to pay everything, upfront at once?
So it's something that has kind of plagued the insurance industry, again being one of those antiquated, of the financial services industries out there. Obviously insurance has been a little antiquated, kind of over the trailing 20 years or so. But the good news is, plugging Founder Shield here, obviously we have partnered with a few different payment partners, or payment processors essentially on the back end, that allows us to actually offer installment plans. So even if an insurance company, occasionally you'll find one here or there that are willing to offer a down payment and then 10 monthly installments or something like that. We see that from certain carriers like Hartford, that also have a small, they're used to the small business side of things and they're really comfortable with it. And so they understand the kind of ebb and flow of the business model when it comes to small or early stage businesses. And so obviously you'll have, the odd carrier here and there that are willing to offer an installment plan right off the bat. But the good news is, let's say we source a program of, a total of 5 or 6 different coverages, like some of the ones we'll walk through today. And only one of them was willing to consider installment plans. We actually have on the back end, right through our online insurance portal, once we assemble all of your quotes and kind of present them in the portal, you'll be able to select all the ones that you want to move ahead with binding, and then you'll be able to click purchase. And when you click purchase, it takes you to a second screen with our payment processor or provider, Ascend. And Ascend actually allows you to choose either a pay in full option or an installment option, which obviously kind of is really, really kind of a benefit or a boon for our early stage clients, because it functions almost akin to a loan or a pay as you go plan, in the sense that you pay the down payment and then Ascend fronts the entire premiums for all of your policies to the insurance carriers, and then they collect your installments on the back end. So the good news is you're only paying, each installment, and you've only paid up through, let's say, 6 months down the line, the company needs to pivot or, kind of close its doors or, kind of reinvent itself. And so these policies are no longer relevant. The good news is you've only paid up through whatever specific month it might be. And as a result, you can ask Ascend to cancel for you, and they can reach out to the insurance companies themselves and say, hey guys, we fronted these premiums. The last 6 months of the policy that we paid for is now unused, obviously, because we're going to be canceling. Can you return that, as a prorated refund or return premium to us? And so the good news is, not only do the clients themselves get to cancel effective, whenever they need to, but also Ascend is made whole. So there's no kind of outstanding balance that the client is responsible for.
Awesome, man. Thanks. All right, let's move on to the next one. So, I'm hiring my first employee. We had a team of founders. We were all, K1. So now we're hiring somebody that we're going to be paying. I need to give them workers' comp. A lot of these people are based in Ohio. So if you could just give a little bit of specifics around that, because I believe it's monopolistic there, if I'm not mistaken.
Yeah, of course. So it's a great question. So in terms of, and I just want to make sure, so this is workers comp here, right? So
Yeah.
because obviously contractual liability on the errors and omissions side, we can talk about that in a minute as well. But from the workers compensation side of things, um, workers comp is a much more straightforward coverage trigger than some of your other some of your other coverages out there that need to be specifically underwritten to the unique services provided or the unique kind of cybersecurity controls a client has in place. Whereas workers comp is such a state regulated coverage that in most states, companies are required to offer workers comp benefits to any full time W-2 employees. Whereas if you're only dealing obviously with 1090, everybody's 1099 as an independent contractor when first getting up and running, then you're actually not obligated to provide any benefits via state law to those individuals. However, there are a few states that are monopolistic, which just means that they do still require companies to offer benefits, these workers' comp benefits to their employees, but they say we actually have, a state-run insurance company, essentially, that a monopolistic entity that you actually have to shop from this specific market as opposed to, or this specific plan, so to speak, as opposed to going to the private insurance market through someone like Founder Shield, obviously. So the only difference between monopolistic states and then the rest of the the U.S. States that just allow for standard workers comp coverage, where you can reach out to our someone like Founder Shield or a PEO, oftentimes also can help on the workers comp side of things. And either way, we can shop around for workers' comp quotes for you and get that, at such time as it's needed for those full-time W-2 employees.
So, Cole, quick question here. So, if my business is based in Ohio and I hire someone that's in New York, I hire a remote employee in New York, they were the most qualified for the job. Where do I go to get their workers' comp? Do I still get it through Ohio?
So it's a good question as well, because generally speaking, workers' comp coverage, like again, using that example or using another example like California and New York or something like that, most states have translational limits. So let's say one state, the required or mandatory workers comp limit that you are responsible to offer for all full-time W-2 employees is 500K. It could be 500K in Ohio and $1 million in New York. It could be 250K in California. I can tell you it's definitely more than 250K in California. But that being said, just for sake of argument here, the good news is when you come to someone like Founder Shield and we source kind of a general $1 million workers' comp policy, it's not like you need to purchase new limits for each state that you operate in. That $1 million limit will satisfy the higher states like New York with a $1 million requirement, as well as other states like California or somewhere else that might require 250 or 500K in limits. So the good news is that if you purchase a policy with $1 million in limit, you are compliant in any state that you are required to purchase lower coverage or maintain lower limits all the way up to $1 million.
Awesome. And can we talk a little bit about kind of like how the different positions are rated? Like if I'm working at an office desk, my risk is pretty low. For the sake of SaaS, maybe I have a salesperson that go out and they make sales calls. Can you just talk a little bit about the difference between the risk with those type of individuals?
Yeah, of course. So, I mean, essentially, the way that putting my underwriting hat back on, pretending I'm back over at Chubb, looking at a kind of a new fresh risk on my desk, thinking about it like that, it's interesting in the sense that each company will obviously has quite a few different departments, different roles at play, and each of those have a different class code or classification of risk. Whereas, like you said, someone like sitting behind a desk and working exclusively on software development, something like that, generally speaking, from a workers' comp standpoint, the potential for injury is pretty low. It might be repetitive motion injuries, it might be eye strain, it might be something along those lines, right? Whereas someone in a warehouse, helping move things around, or if you offer on-site support for your software, and someone is helping a client set something up on site, and a monitor falls on someone, or a bank of server bank falls down, and injures people, or that there's heavy lifting involved. Obviously, a different classification of risk involved there. Similarly, for those outside sales individuals that are driving, maybe their own cars around for sales calls, trying to visit, you know, uh, customer locations or client locations, things like that. Obviously, there's a much different risk profile involved there because there's a potential for injury, whether it's on site at that client's office or in that driving distance between the two. So obviously,
Yeah.
um, anywhere in between, or if it's at a lunch and someone chokes on a lobster tail because they don't know how to eat it, right? I
Let's not get too deep into the weeds.
we've seen it all. But no, that being said, each classification is rated entirely differently. And so the good news is what you do is when you submit a workers' comp form, you'll actually list out, okay, how many clerical office employees do you have, how many outside sales individuals do you have, and then when we send that off to the underwriters, they rate it up, and so each individual will have their own kind of rate per the class code.
Perfect, man. I wanted to help folks kind of understand, what they could expect and why they may see, different workers' comp amounts for different things. So that was great. Thank you.
Absolutely.
Let's go back to the, aero and emissions, also known as professional liability. So in this case, I'm getting ready to launch my software. What is professional liability going to do for me, and why is this such a pivotal insurance for SaaS companies?
So, I mean, it's if I'm being honest, this is one of the two that I would say is the most core coverage for SaaS companies. Well, in tandem with cyber, which obviously we'll touch on in a moment, but in speaking about them, kind of interconnected. Just that another the most common coverage trigger for E&O is that you know also known as, again, worth mentioning because sometimes people might have heard it mentioned a different way. Errors and omissions is the same exact thing as professional liability. It's just that, again, part of the insurance market, or the history of the insurance market goes back to London, and so different markets call it professional services liability, some call it errors and omissions. It is the same exact thing. So just like to get that out there in case they're like, yeah, I have professional liability, do I need errors and omissions? The answer is, if you've got one, you're all set. So that being said, essentially, let's say you're getting ready to launch your software, or you go live with a client, or you're engaging in an RFP and land your first enterprise contract with a customer, and they're going to require you to have professional liability in the event that there's a failure, error, malfunction, or downtime in your service offering once it goes live. And so technically, if any of those things happen, whether it's a failure, an error, or any kind of downtime, you're technically contractually obligated via your signed agreement with that party, via your customer or client, to provide that service. And even if it's not a critical service to your client, if it's a dashboard or something like that, if it goes down as a result of a cyber incident, outage, or something like that, you're technically in breach of contract, and they can file suit for any damages or lost income incurred on their end as a result. And so errors and omissions, as soon as you begin engaging with that first kind of contract that goes live, or that first the service is launched itself, let's say it's a marketplace software play, some kind of shared economy marketplace, as soon as it goes live and you have actual users using the product itself, there's that risk of, if there is downtime and someone is paying for that service, they could potentially file a suit saying, hey, you're in breach of contract here. I either lost a potential client on their end, or that was going to be valued at 50K, and so they're going to sue you for that. Or they might say, look, the downtime on my end, I you know want my money back for whatever amount of time the service was down for. So that being said, errors and omissions is going to be one of those. Again, any kind of lapse or gap in your professional service offering, and this is why it's so kind of closely tied in with cyber here, which I'm sure we'll touch on next. But any other questions on the errors and omissions side that I didn't get to, Josh?
Um, I think the only question that I guess I would have on the errors and omissions is, um, with the downtime, like what is going to be covered? Like what expenses? If somebody sues me because my service has gone down, what exactly is going to be covered by the errors and omissions? Are they covering, the amount of the suit? Do they cover my lawyers? Can you just go into a little bit more detail about, how it helps me?
Yeah, of course. So, I mean, and obviously, and this is going to sound, rather, insurance or lawyery. So, apologies in advance, but it truly does depend on the individual claim, just because, it depends on the nature of the suit. If someone is filing suit saying, hey, I lost because of the downtime in the service in your service offering, or the failure in your service, I lost, X amount of data that I had that I was planning on, making X amount of money off of, and they try and sue you for, the amount that they lost. Obviously, when it goes to, kind of goes to legal proceedings, this policy, these E&O coverages do step up to pay for legal defense costs, as well as damages on, later on down the line. So what those damages look like obviously does vary from claim to claim, and so, or from instance to instance, what actually was kind of the downstream effect of the lapse in that service offering. So again, the kind of damages awarded can obviously be kind of a little bit nebulous, just because it does depend on the instance. But that being said, it does step up to defend for both legal defense costs as well as those damages awarded.
Cool. Okay. Thank you. So next, as you alluded to, we'll hit on cyber. This is obviously another huge one in SaaS. Once I start collecting information from third parties, why is cyber insurance going to help me with this?
And it's like I said a moment ago, it is pretty much, if let's say, even if it's not a contract requirement, if you were launching your, the software service, the second that it goes live and you begin handling, others or third party data that's now in your care, custody, or control, which are the big three kind of, kind of triggers for liability on that front. Obviously, if there's a cyber incident that results in some kind of, loss of that data that requires backup, recovery, remediation, or there's a ransomware or cyber attack incident that, you have to actually notify your clients that, hey guys, we are required by law to notify you that we had an incident. As a result, your data was affected. It's been, kind of released, or, released on kind of whether it's the dark web, or it's been, held ransom, and there's this remediation cost that we're working through with a third party forensics firm to kind of work through and actually kind of get your data back. Any of those things, you obviously are required to notify clients. But this is why, when using that same scenario or same example above, when clients come to us, one of the most common triggers for both cyber liability along with errors and omissions is, hey guys, I'm working through an RFP with a potential, onboarding my first enterprise client or a first enterprise contract, and they're requiring me to have both errors and omissions and cyber liability. Why is that? What do I need it for? So using that example, they are, like I mentioned earlier, pretty inextricably linked for clients in the SaaS space, because when you are responsible for any of that client data in your control, and a cyber incident, whatever type of incident it might be, it's likely going to lead to downtime in your service offering as well. And as such, any suit that's filed by one of your clients is probably going to say, hey, I'm suing you as a result of, the downtime of the service offering, but also the loss of our data that you were responsible for handling. And as a result, obviously that claim is going to hit both the cyber and the E&O policies. And so the good news is that these days in the marketplace, there are very few carriers that are willing to, underwrite a SaaS client or a potential new SaaS insured, and offer a standalone errors and omissions or a standalone cyber. These days, the two coverages just come, kind of hand in hand on the same policy form. So, the
Awesome, man.
good news
Yeah,
is
I'm gonna have some more questions about the cyber, and I also want to dive in a little bit deeper on this next one. So directors and officers insurance. Um, I'm going out to raise money. I'm starting to get questions from investors asking if I have, director and officers insurance. Why are they asking me this?
And so that's actually, aside from cyber liability, errors and omissions, or general liability, obviously the few that we've touched on so far, whether it's due to, something like an investor requirement, or just a founder wanting to be proactive and protect themselves, as well as the company, directors and officers is probably one of the most frequent coverages that we actually source for clients. So reason being, like you just mentioned, Josh, it does become a need for clients as soon as they begin making representations to potential investors and raising their first round. And so that first round, or that first fundraise, is usually the trigger that we will have founders reach out to us for, or some of the funds that we partner with. If they're considering investing in a potential new, portfolio company, they'll say, hey, we're considering investing in, XYZ company. Can you help them secure directors and officers coverage? And the reason being, is that the investor wants to make sure that not only is their investment in the management team protected, in that those founders are protected from any decision they make, in managing the company, but also that the investor themselves is protected in taking a board seat, as well as being, in bed with the new portfolio company, since coverage will apply for both officers of the company as well as the board of directors, which is why it's known as directors and officers coverage.
Okay, and we'll dive in a little bit more, but can you talk a little bit more just like about like timing, like when, you know, when am I wanting to really start sourcing this? Is it, is it right away? Is it something that if I get a quote for it, it holds on for a little bit, or just kind of give me a little bit more clarity around timing.
Yeah, yeah, absolutely. We can definitely dive into, like you said, some of the deeper stuff about underwriting and how to position yourself best for that D&O endeavor. The D&O quote sourcing efforts or coverage sourcing efforts. But when it comes to timing, I would truly say, as soon as you are, taking on any outside funding, you are, taking on that first, fundraise, that even engaging, with, potential investors, things along those lines, and making representations about the company. Because one of the most, or which as well, I'm sure we'll get into in a few moments, one of the most common, claims triggers for a D&O policy is actually a shareholder lawsuit, where, let's say I'm an investor and you made a representation as a founder to me about what you were planning to do with my money, and I say, okay, sounds great to me. Here's the projections that you told me you were going to hit by end of year, or in the next 18 months, whatever it might be. And I make the investment, and then 18 months down the line, the investment's not going quite the way I thought it was going to go. Obviously, there might be disgruntled investors, things along those lines, and a shareholder, lawsuit is again one of the common claims against a D&O policy. And so, that being said, it's usually along the lines of, as soon as you begin, start kick off that funding round and start making representations about the company to potential investors, that's pretty much the trigger in terms of when to start looking into D&O coverage.
Awesome, man. Thanks. The last thing I'm going to hit on this slide is just, I think it's really important to just get the coverages that you need, like right now. And I think that's one of the ways that Founder Shield is really good about, working with founders, is that, we understand that the runway needs to go as far as possible. So there's some things that can, you can wait on, and there's some things that you can't. And we can really kind of help guide you on that risk path and say, hey, let's wait until that investment to get that DNO. Like let's hold off on that for right now. Or hey, when does it make sense to bring on this first employee, because we know we're going to have to start paying them workers' comp. Just kind of advising you on how to best streamline that, how to put coverages together when they're most necessary, as kind of Cole was talking about, bundling that E&O and cyber together. There's savings within that, and that's a big benefit what we can do versus maybe a traditional broker that may just kind of be sourcing policies to help you get that coverage. So we'll just take a quick pause and see if any questions have come up in the chat. Hopefully, so far things are digestible, and but if anybody has any questions, we just really want to take a moment and be able to answer those.
Absolutely. We did just throw a lot at you guys over the last few slides. So if there are any initial questions, awesome. If not, no, and things are still sinking in, there will definitely be another Q&A section later on as well. So no pressure.
I don't see any in the Q&A. You folks are also welcome to raise your hands and we can unmute you. Actually, we just got one. Joshua is asking, can you place something in your terms of service cover service downtime?
Absolutely. So, I mean, Obviously, when it comes to any kind of insurance, regardless of whether it would be, errors and omissions, something along those lines, or potential cyber incidents for cyber coverage, or even directors and officers when you're engaging with obviously investors, things like that. Your contract is pretty much your great wall. It is your first line of defense, and then the insurance, sits behind that in the event that an attorney comes along that is good enough to be able to find a crack in that contract or in that first line of defense. That's when obviously the insurance will step up, obviously, to help safeguard the rest of that lawsuit. So, but it's a great point to make, because oftentimes we have clients that say, here's here's what the contract is. I've made it very clear in this agreement with whatever vendor or potential customer that I'm working with that we have X amount of leeway of downtime before they can file any kind of lawsuit or take any action against us, or before we have, let's say, 24 hours to kind of remediate anything before it becomes an actionable issue or actionable item. Because obviously getting clients to agree to certain safeguards like that obviously just pads you guys a little bit more in terms of protection. So any terms like that to add into terms of service obviously are to your benefit. Now, obviously, in a real life claim scenario, the level of defense that it actually, or amount of defense it actually provides will totally depend on whether or not, again, the customer or client has an attorney that is kind of chomping at the bit or hungry enough to try and find a way around that clause. So it's a great question. The answer is absolutely. Any contractual controls or buffers that you can put in place obviously are only to your benefit.
Thank
Awesome. Thanks
you.
for the question.
I don't see any others if you want to proceed.
All right, so we're going to dive in a little bit more into D&O, and not too far in the weeds, but I think we just want to talk about the different parts of the D&O coverage. So Cole, if you could just kind of start with clause A, and then we'll just go through the three sides of D&O and what those pieces cover.
Absolutely. And also feel free, Josh, to pull back the reins at any time if we are going too deep into the weeds. So,
Will do.
but yeah, happy to jump in here. So at the highest level, a D&O, policy, again, like we talked about on the last slide, it does obviously step up to protect the directors or officers for any management related decisions, in steering or guiding the company. And so there are, in terms of the actual insuring clauses or agreements on a D&O policy, what you'll see once, a quote is sourced and we send along for your guys' review, you'll see that there are three main insuring agreements. Obviously, side A, which is what we call, individual director, but non-indemnifiable. And what I'll actually do, Josh, is touch on A and B here kind of in tandem, just because it's easier to
Okay.
mention how they play off each other and how they play against each
Okay.
other. So, well, against each other in a amenable sense, which is actually a good thing. But that being said, so both sides, A and B, are actually your individual director level coverages. Say a specific founder or a specific director is named in a suit, saying that there was some kind of level of management malfeasance, a misrepresentation, some mismanagement, whether it's of funds or otherwise, some level of allegation levied against a specific individual director. These D&O policies step up to pay legal defense costs, obviously, for that director, so that the director is not responsible, or their personal assets aren't obviously at stake there. So the only, kind of identifiable difference between A and B, or sides A and B, is that A is known as non-indemnifiable, individual director level coverage, and B is indemnifiable. And so all that really means is that obviously, companies do have the responsibility to step up and defend their directors. So in an indemnifiable scenario, in which usually solvency is the main kind of trigger point here, or cornerstone here, if the company is still solvent and obviously has the funds to pay the legal defense fees or legal costs for their director, the policy will pay directly into the company's kind of coffers, or pay the company so that they can defend their director. Whereas in an scenario where insolvency is at play, obviously a lot of directors and officers claims actually do kind of come up when there is an insolvency concern or a bankruptcy filing, where an investor is going to say, hey, I'm going to file a suit against you because I made this investment, it went downhill, and I'm going to blame the directors, in this specific director, for making incorrect management decisions and tanking the company, or whatever the allegation might be from said investor. Obviously, if the company is going bankrupt and filing for insolvency, obviously there's not not likely a whole lot left in the coffers to step up and defend that individual director. And so, in a non-indemnifiable scenario under insuring clause A, which again is that individual director level coverage, the D&O policy will step up and actually pay directly into that individual director's pockets to pay for those legal fees. So the only difference between insuring clause side A and B is truly just the level of insolvency at play, or whether or not the company can indemnify or step up to defend its director. And so both will step up to defend the individual directors, but it just depends on kind of the scenario or the status of the company at such time.
Great. Thanks, man. And now we'll move into side C. I believe that's the, company based.
Exactly. Yep. So side C, there you go. I got my voice back. Apologies, guys. All it took was a sip of water. But so side C is your entity. We just call it your entity level coverage. It's your balance sheet protection. If a claim is made against the company as a whole, obviously that it's not naming any specific director who could be mismanaging, or it's not filing a suit for any specific decision made by an individual director, and it's just a claim against the company. Usually these are things like, let's say the company brings over a new onboards a new director. Let's say you're building out your team, your management team. You hire some absolute rock star from one of your competitors who is a genius at partnerships, like Josh here. And let's say you bring someone over, and their prior employer is going to say, hey, you're poaching one of our all stars, and they're going to bring with them some trade secrets. We're going to file suit against you, right? And so that's where it could just hit the entire company, and as a result, the policy will step up to obviously pay legal defense costs for the company as a whole. So it is both. It's a unique coverage in the sense that D&O does protect the individual directors to make sure that you guys, as founders, obviously have protection for yourselves and your personal assets, as well as the company as a whole. The only asterisk worth mentioning here is obviously that it does, the burden of fault does kind of play a role here. Most directors and officers policies do include a clause known as a duty to defend clause, which obviously means that they do step up to defend you and pay legal defense costs until a verdict is reached. And then usually insurance policies will also pay out for the damages as well. But if it was determined that there was some intentional mismanagement, or the burden of intent was determined that there was a decision made that was with kind of willful intent or willful knowledge that it was kind of mismanaging funds. Whereas I always use an example, and again, not naming any clients, but there's always a kind of a one that comes to mind, in that we had a client raise a massive Series B. It was a huge success, and then a few months later, the founder got a beautiful new yacht, and while it's a great kind of reward to oneself after a successful round. That being said, some of the investors started looking into it, saying that this might have been some level of mismanagement of funds here. So obviously that's another instance of that shareholder suit that could be filed, saying that there's a certain director malfeasance, or management malfeasance going on in mismanaging funds. And obviously, if it is determined that funds were indeed mismanaged with willful intent, of course, the policy will still step up to pay for legal defense costs. But when that verdict is rendered and the burden of intent is found, then defense or damages will not be paid out. So always just something to keep in mind, because we have had founders in the past that say, hey, it doesn't matter whether or not I'm at fault, right? I'm still the policy still steps up to defend me. And the answer is, unfortunately, insurance only goes so far as to the burden of intent.
All right, so my hopes of getting a yacht are dashed. Thank you, Cole.
Sorry, Josh.
Last kind of question that I just wanted to kind of clarify around the D&O before we move on. If the person that is investing doesn't take a board seat, will I still be required to get the D&O, or should I get the D&O just for my own self?
So the answer is whether or not an investor says I'm taking a seat on your board and I want to be protected, in getting into bed with you, or I will only get into bed with you if I know that I'm protected via your D&O policy. Even if they don't say that, and you're still making representations to potential investors about the course that you or the trajectory of the company that you are planning on using any funds for, it is still definitely kind of a required, or even if it's not required by said investor, it is definitely still a recommended coverage or liability to have in place.
Okay, awesome. Thank you so much.
Yeah, of course.
So we're gonna dive into cyber a little bit, and then we'll stop again to see if anyone has questions about the DNO and the cyber, in which we're going to talk about here. Um, we touched on why cyber is important. Can you talk about the first party versus the third party, and what are the differences there?
Yeah, absolutely. And actually, just not to jump around, but do we also want to talk? I know we plan on also talking, in the next slide as well, about how to position oneself kind of most favorably for cyber from a
Yes,
cyber underwriting standpoint. Would it be worthwhile on the D&O slide, that we just touched on as well, to walk through kind of how to what the underwriters are kind of thinking about when they're looking at a D&O submission, and how best to kind of position yourself there?
absolutely.
Cool. So, I mean, just again, I'll make it quick, but essentially, doing a little bit of a deeper dive into the D&O side of things when it comes to what underwriters actually look for. And this is, again, just key when, that first round that you're looking into raising, obviously does kind of rear its head, and you say, okay, well, if we're going to do that, we should look into D&O. What do we need to do to position ourselves most favorably? So at the highest level, underwriters are going to look at two main things, which are good to keep in mind, and that pertain to the who and the what. Obviously, the who is the cap table, but like we just talked about, with directors and officers, as well as major shareholders. And so from an underwriting perspective, underwriters usually consider anyone with 10% or more stake or equity to be a major shareholder. And major shareholders are someone that they're going to want to see, okay, if someone has above that 10% threshold, do they have a seat on the board? Because generally speaking, that is a really common, you know, uh, common claim that they see, and actually, unfortunately, usually deny. If someone with, let's say, I have 25% stake in the company as an investor, which that would be definitely a sizable chunk for some rounds. But that being said, let's say I have 25% stake and I don't have a seat on the board, or I wasn't given a seat on the board as part of the investment. Um, if I have some kind of grievance or concern about the way the company is being run, and I don't have, the ability to voice that concern as, and use, vote on the board. My only recourse to affect change regarding my concern is actually to file suit. And so the underwriters see it as a really, really easily avoidable lawsuit scenario. And they say, okay, because of that, we want to see that most major shareholders, or all major shareholders above that 10% threshold, do in fact have a seat on the board. So just something to think about as you guys are working on structuring kind of the who of the company, the cap table. Definitely something to take into account, that underwriters are going to want to see that anybody with over that 10% threshold does indeed have a seat on the board. So just one thing to note on the who. And then when it comes to the what, obviously, whereas the who is the cap table, the what is the financials, whether that's, usually underwriters request the whole suite of financials, balance sheet, P&L, or if pre-revenue, obviously any pro forma projections that you guys have on hand. And so that being said, they're just going to want to look at the viability, obviously, or the projections for the next 12 to 18 months. And, just be reassured that you guys do have, even if you don't have enough funding on hand for the next 12 to 18 months, that you at least have, plans via raising a round to sustain operations for the next 12 to 18 months. Just because, in putting my underwriting hat on, usually underwriters say, okay, well, these are annual policies. These are 12-month long, policies that we're offering coverage for. And if they don't have 12 months of runway, and 8 months down the line, insolvency becomes a concern, and claims start flying around from debtors or creditors trying to actually, recoup their losses. And all of a sudden they see this, $1 million insurance policy on the books. It's going to be, in their mind, just a piggy bank to kind of draw from. And so the underwriters do usually like to see, so that they don't become one of the largest assets on the balance sheet, or their policy doesn't become one of the largest assets on the balance sheet. They do usually like to see some evidence of, that runway, or at least plans for funding.
Oh, that's awesome, man. Thank you.
Yeah, of course.
All right. So now that we have some understanding around the DNO, let's, kind of jump into cyber. I think, we've all seen the ransomware and things like that. Let's talk about kind of how it's kind of broken down.
Absolutely. So when it comes to the cyber side of things, obviously pretty, easy, easy diagram here to break it down. So it is, most cyber insurance policies do have, regardless of carrier, they all, will, each quote will look a little bit different in some of the sublimited coverages or additional benefits that each carrier is willing to offer. But either way, they usually fall into the two main buckets of first party and third party benefits. And generally speaking, all those are is, obviously, when it comes to first party, think of that as your internal out of pocket expenses. Like if there is some kind of breach, or you do have an incident that requires you to respond or notify any of your customers, hey, by law we are required to notify you that there was a cyber incident within our platform, or there was even upstream, let's say one of your vendors that you use, right? One of the cloud providers that you guys use, had an incident at a higher level, and it kind of trickled downstream and affected you guys as well. Well, more likely than not, your clients are still going to, be affected. And so this is when the policy does step up to help pay for those out of pocket internal expenses, whether it's, think of it as your backup, your remediation, if you need to hire that, forensics, bring in a forensics consultant to help you recover any lost data, or if there is that business interruption on your end. So that's a first party cost. If you guys, as a result of some cyber incident, experience downtime, and there's, let's say the business is interrupted for 72 hours, and within that 72 hours you guys were expecting to pull in 150K or whatever it might be, obviously the policy does step up to obviously help pay for any business interruption costs, to obviously keep things running, keep things going. And then the last bullet there, the cyber extortion and ransomware, again, that's what the policy is here for as well, to safeguard any ransomware or extortion scenarios that do pop up. If someone is holding data ransom, obviously you need to bring in usually a third party, or consultant, or law firm to actually help you guys work through that ransomware negotiation, or anything that it takes to kind of unlock that data, and kind of bring back or recover that lost data. So that being said, all of these are usually included as one of your first party, or under the first party insuring agreement on a cyber policy. These are all different line items. And again, I'm sure, as you guys will see, as you all kind of continue on this journey to scale, and you start, cyber becomes a relevant coverage that you need, and we start sourcing quotes, you'll see that sometimes certain carriers will sublimit certain of these internal, coverages. And all I mean by sublimit is sometimes they'll say, oh, we're willing to offer up to the full $1 million limit for this one, but for this one, we're only going to offer a 250K benefit. And obviously that's where we have some flexibility to try and pull levers with the underwriters, and kind of play different, carriers in the market against each other to try and actually get you guys the most comprehensive terms that we can. So that's the first party side of things. Going to the third party side, obviously think about this as any kind of third party action, right? Meaning one of your clients, a customer suit or something like that, saying, hey, you guys, obviously, there's an information security concern here, and they file a lawsuit. It'll step up to debate, again, similar to the D&O side of things. All insurance policies are here to help pay for legal defense costs. And so that's what the third party side of things will do, is step up to pay for defense costs, as well as if there is a regulatory investigation as a result of regulatory penalties for not being in compliance with, let's say you're handling PHI data, right? Like healthcare data, for a lot of our clients, especially myself up here in the Boston area, a lot of biotech or health tech clients. And if they're handling any kind of sensitive, information or sensitive data like PHI, or, some of the more sensitive personally identifiable information, or PII, obviously, there are certain statutes around that companies need to be in compliance with. And if there is any kind of regulatory investigation or penalty, because you obviously were weren't in compliance with it or things along those lines, the policy will step up, obviously, to help pay for those investigations or remediations to bring you guys into compliance with regulators in your industry or with whatever regulatory framework like HIPAA or PHI statutes.
Yeah.
And
I,
go for it,
I
Josh.
think, I think one thing that I really want to mention here as we're talking about cyber insurance is that, we had mentioned that insurance can be a bit antiquated, and with a cyber policy, the most important thing here is time and how fast that your partner is going to be able to move to get you the help that you need. So as soon as something happens, as soon as there is a ransomware or something along those lines, you really need to move fast, because the longer that they're able to be within your system or access your files, the more expensive things are going to get. So it's really important to have a partner who can work with you through this process, help you with these claims, and help you move through them quickly.
Absolutely, which is actually a great spot to mention a recent coverage that's kind of just become a new thing. It's as far as I'm aware, there's pretty much only one carrier in the industry right now that's willing to offer it. It's actually known as cloud downtime or cloud outage coverage. And so basically, what this coverage is, so for a higher level background, most cyber insurance carriers in the marketplace usually include a waiting period for how long an actual cyber incident needs to result in some kind of business interruption or downtime before the policy will kick in. Now, the floor for that is usually about 8 hours, right? So it's one of those where if there's an incident and you can get it remediated within the same business day, within the 8 hour workday, generally speaking, the likelihood that you see lawsuits from any kind of third party customers, clients, things like that is the underwriters are willing to take that bet that there's not going to be a whole lot as long as you get things fixed within that same day. Whereas on the flip side, once it goes past that 8 hour mark, and now obviously you're going into the next day, that's usually when from a loss or claims perspective, that's where the underwriters usually see most of those claims pop up. So that being said, what Josh just mentioned is kind of a great point, because let's say you guys went on to some of those other online insurtech portals and just clicked answer 10 questions and it popped you out a cyber quote, and it didn't highlight the fact that there was an 8 or a 10 or a 12-hour waiting period before that coverage would kick in. Well, there is actually another coverage to help you guys fill that gap, and this cloud downtime coverage will actually kick in at the 2 hour mark. And so if that's something that you guys are interested in as well to kind of fill that gap, it's pretty much a white space in the insurance market that's really only been filled within the last I don't know, year or two maybe. So definitely something worthwhile to note as well, that working with Founder Shield, we do have relationships with that one carrier in the marketplace that's recently started offering that coverage, so we can definitely help fill that gap and make sure that you guys obviously have coverage that kicks in as soon as possible. So that being said, on the third party side of things, the last bullet I don't think we touched on yet was that technology and media liability. So I know we've already kind of hit on it a few different times, but for clients in this SaaS industry vertical, obviously cyber and E&O, or the professional liability, do kind of go hand in hand. And so, under this cyber insurance policy that's usually bundled with technology liability or technology errors and omissions, you will usually see on these cyber policies some level of errors and omissions and media liability bundled into that same policy. And so, I don't know if it helps for background, but 5 or so years ago, you could probably get those standalone E&O or standalone cyber policy. But what was happening was, let's say you guys had a cyber incident that resulted in downtime, right? And so you need to file a claim against both your E&O and your cyber policy. Well, if 5 or 6 years ago, when you went to your E&O carrier and said, "Hey, I'm being sued," they said, "Well, it's as a result of a cyber incident, so we're going to kick it over to your cyber carrier. We don't want to pay out on this." Then you'd go to your cyber carrier and say, "Hey, they said it's because of a cyber incident." And they say, "Well, it might have been perpetrated by a cyber incident, but you're being sued because of the downtime in your service offering. So we're going to kick it back to them. We don't want to pay for this." So what was happening quite a few years ago was that clients were kind of left in the middle of these two carriers paying for both policies, but left holding the bag in the sense that neither carrier wanted to pay out. And so fast forward to today, obviously, that's why, like I said, most insurance carriers that either offer, that kind of play around in this marketplace, usually bundle the cyber and the E&O together so that you guys are covered regardless. There's no kind of back and forth between different carriers. You just can, it's a one-stop shop. That obviously you're covered on both accounts there.
That's a really good point. Yeah. Nobody wants to pay out. Yeah.
Hey, I mean, that's
Uh,
how insurance companies make money is collecting premiums and
yeah.
hoping that they don't have to pay out. And obviously, our job as the brokers to make sure that we hold them accountable to the policies that they issue. So
Yeah.
that's our gig.
Absolutely. And we have a, claims team that will help with that. So let's move into kind of the underwriting approach and point out some things that people can do to kind of get some favorable pricing when it comes to the cyber insurance.
Absolutely. So when it comes to setting yourself up for, cyber insurance success or success in the in the cyber insurance shopping or underwriting process, whereas D&O is more straightforward, like we talked about from an underwriting perspective. I.e., there's a few things they like to see. Do all major shareholders, have board rep, and can you evidence enough funding or sustainable runway for the next 12 to 18 months? So obviously, that as long as those few main points are hit on, usually carriers are pretty comfortable offering D&O coverage. On the flip side, cyber is a little bit more nuanced from the way that underwriters actually rate each individual company's risk. And so what they'll do is obviously we have our online application portal, which I know Josh mentioned at the beginning of the kind of webinar as well, where you can pop in there and select any form you'd like. And when you select the cyber form, you'll see that there are quite a few different types of cybersecurity controls that you can obviously select whether or not you currently utilize. And so there are definitely certain cybersecurity controls um, you know, within your environment that underwriters do want to see in place. They want to ensure that you're safeguarding your data to the fullest extent as possible. Obviously, your data as well as your client's data. And so some of these controls you can see here up on the slide, which are multi-factor authentication, whether that's push based or a one-time passcode based. Either way, they want to know that there's some level of multi-factor authentication in place. So, when accessing your environment. Similarly, next-gen antivirus, endpoint detection response solutions, as well as they want to kind of figure out what your backup cadence is, right? So obviously, if you're only backing up data once a month, well, if you have a cyber incident, it's going to take a lot more effort to try and figure out how to recover all that data as opposed to if you back up, you know, your your backup policy is daily, right? If or even if it's instantaneous, right? If it saves or backs up on the cloud, almost instantaneously, or do you have hard copy backups, kind of segregated from the rest of your system, right? So if something happens, to your first copy, do you have that backup or that backup copy that you can recover your data from? And so they want to know the frequency of your, of your backups, whether you guys have immutable backups as well, which is something that's not necessarily a box that's required to be checked by any means, but definitely the frequency of your backup policy is something that they look into as well as lastly encryption on as much data and endpoints that you guys are able to obviously encrypt. So that being said, those are just a few of the main or high level ones that underwriters they've been kind of hot button topics or hot button issues. But I will also say, and I'm not going to misquote it, so I won't even bother. But there is a rather substantial percentage of claims recently that have been stemming from the lack of MFA being in place. So if there's one takeaway from this entire slide here, it is wherever possible implement multi-factor authentication, because the underwriters are definitely going to ask for that. And so that being said, if that's where the vast majority of claims that these cyber underwriters are seeing come in, if they're all resulting from a lack of MFA, obviously they're going to want to see it going forward. So that being said, that's probably one of the key things to touch on here. And then,
Yeah.
Go for
It's a
it, Josh.
pretty, yeah, I mean, that's a pretty nice and easy step, I think, to take, that just kind of puts you out of the lowest bucket. From we have, quite a few IT consulting partners, and a lot of them talk about just the importance of multi-factor authentication as just a first big step, because a lot of times the hackers and things like that, they go after the lowest hanging fruit. And I just wanted to touch on culture and awareness. It might be a little bit surprising to see that there, so I just wanted to give a little bit of context to what that means. um, I think it's 60% of hackers get in through phishing and emails. So just bringing a culture and an awareness to, hey, there's suspicious emails. I think, for us, we have a Slack channel. It's like, hey, did anybody get this really shady email? And we're, we kind of joke about it a little bit, but it brings a culture of like, hey, who can bring something to the table that seems out of place, and that brings awareness to the entire team of hey, don't click on this email because it's a phishing scam.
It's definitely a great thing to talk about as well. Those phishing trainings, and as much of a culture of awareness that you guys can cultivate within the amongst the team within the company is definitely to your benefit as well, because it is one of those things that all it takes is someone being on the phone and distracted and clicking a link in an email, and all of a sudden you've activated your policy and you are kind of knee deep in a cyber claim. So that being
Yeah.
said, definitely a key thing to mention as well. And one other thing just to touch on as well, or maybe another side note that's worthwhile mentioning, is that a useful development in the underwriting process as of late, probably within the last year or two, is that many carriers actually have developed their own kind of internal scanning tools that actually can scan your guys' networks from the outside. Obviously, it's not an intrusive scan, but from your web-facing presence, basically, right? They can scan your networks from the outside and actually assess your footprint in the public-facing domain and see if there are any existing gaps that they can identify right off the bat that they want you to remediate, sometimes even prior to binding. They'll say, hey, we did our underwriting, based off of their application. We also did our own scan, and we saw that they had, some of these, whether it's outdated controls or outdated gates or whatever it might be, that could be gaps in their potential public-facing, domain that a hacker could, or a bad actor could actually utilize. That could perpetrate a breach. Obviously, they might say, hey, we want this remediated prior to us actually being willing to bind this quote. We're still willing to offer the quote, but we want to see that, remediated prior to bind. So that might also be something that you guys can use leverage to your benefit as well, is to say, throughout the course of the policy term, you guys are always, welcome to, again, reach out to your cyber insurers and say, hey, can you issue an updated report to see, how our cyber positioning, or our cyber health from a public facing standpoint is looking currently? And obviously, a lot of these insurance carriers and underwriters are more than happy to issue these reports for you guys, at any time or at a moment's notice. So just another benefit to, mention. It's not really, obviously, from a cyber coverage perspective, not one of the main benefits of a cyber policy, but it definitely helps, just you guys keeping tabs on your kind of cyber positioning.
Awesome. Well, we'll take another break for questions here, and then we have a couple tips, and we'll go ahead and wrap things up. So, once again, if anybody has any questions on some of the things that we covered from a D&O standpoint or from a cyber insurance standpoint, and any examples that you may have come across or seen, happy to talk about those.
Again, folks are welcome to raise your hand and we can unmute you if you would like to verbalize your question. Go ahead, Joshua. You can raise your hand or you can put it in the Q&A. We can't hear you, Joshua. Looks like you're unmuted though.
Oh, can you hear me now?
Yes.
Hey.
Okay, thank you. Okay, my name is Joshua Walker. I'm with Task Hub. I do have a few general questions about coverage for taskers.
Sure.
So with our service, contractors do have to have their own insurance. We want to know how are damage claims handled in a scenario where the contractor is on site and maybe something breaks. Are we able to, provide that insurance information to the customer, or it does that information have to be provided by the contractor his or herself?
So I mean, it's a great question, because for a lot of, for specifically this business model as well, where it might be a marketplace where you have different contractors or different individuals going on site, perform tasks for other clients that kind of book them on whatever marketplace. Um, it's one of those where obviously I'm really glad to hear that you guys obviously already require contractors to be vetted and have their own coverage before they're willing to or able to kind of perform services on behalf of the company. And so the good news is that obviously if something happens obviously as a result of the service that they're providing on site, your guys' insurance will actually sit almost what we'd call as like excess, sitting as a second layer over the you know the contractors that are on site. So their insurance is usually triggered first in these scenarios, obviously because they were the individual who is liable for this. Or if because a customer says or a client says, hey, regardless of whatever this contractor did, I'm going to sue the company that put me in touch with them, or actually I'm interfacing with this company who provided me this quote unquote vetted contractor. And if I for whatever reason, if there is damage or something like that while on site, if you guys are looped into a claim, obviously coverage will obviously step up to defend you guys, and then your policy or the insurance carrier that you guys are working with will actually subrogate from the contractor's policy, reach out to obviously recoup damages from their policy, because it was obviously the contractor that is at fault in that scenario.
Is there a specific name for this type of insurance?
So it's a great question. It's actually just your standard, for instance, like Arizona emissions or general liability. One of those two will usually pick it up, because Arizona emissions, think about, you guys as your professional service is providing access to a marketplace of vetted contractors. And, if for whatever reason you guys, if it's seen as a breach of contract or a failure in your service that you didn't provide a vetted contractor, obviously for damages awarded, it could fall under an E&O policy. Whereas on the flip side, if the contractor actually, if there's property damaged or something like that, general liability, could step up, in that regards as well from a property damage perspective. But obviously, either way, regardless of whether it's your Arizona emissions, insurance carrier, or your general liability insurance provider, either of them would either way would likely subrogate against the contractor, because as you mentioned, per your agreement with them, they're required to have their own coverage so that you guys can actually recoup losses, from their policy.
Okay, understood. So that would pretty much work the same as in a different scenario where a tasker, let's say a tasker has a pickup delivery and must deliver to a customer. Let's say the tasker doesn't just keeps the item and doesn't deliver it to the customer. How are it will be the pretty much the errors and omissions, or would that be a property loss claim or
So it's a good question, and in the instance of theft, obviously, and that's usually where one of the other coverages that we mentioned, quite a few slides back, earlier on, the commercial crime package, right? So as you guys, or any of our other clients, as they continue to scale and you bring in, additional outside contractors, or, you're growing your team, and, there is, an active employee or, independent contractor dishonesty that results in theft from either you or your clients, or in financial damage as a result, usually a commercial crime policy is what is kind of needed to step up in that instance.
got it? Okay, so there's no insurance to cover both like both scenarios where let's say something is damaged and maybe something is stolen.
So yeah, correct. It would definitely fall under, kind of just some separate actual insurance policies. Now, obviously, you know, uh, in that instance, it would still all be under your Founder Shield managed program. So all you would need to do is pop into the portal and report a claim. And then we have a whole, like Josh mentioned a moment ago, we have an entire claims team with decades of legal experience. They're fantastic. And what they basically do is they'll help you report those claims to whichever carriers, obviously, are going to be responsible, or whichever policies are going to be hit by each kind of segment of that claim, so to speak, or that scenario. And obviously, they'll make sure that the carriers step up to pay their respective portion of that kind of loss or that incident.
Okay.
Just want to clarify, is there a policy that covers theft, or crime needs to be there in order for a theft of a vetted tasker to be covered? I think that was the question, if I wasn't mistaken.
Yes.
So you're saying it
So
just
like,
is.
would crime be covered under general liability or error and omissions, or if because they're saying that this is a vetted tasker, that would be considered kind of like an employee and they would really require that crime?
So looking at it in that light, I would say because they could file suit and saying that, hey, you failed to provide your agreed upon service in vetting this contractor, so I'm filing suit for misrepresenting your services or failing to live up to the agreement. So I guess in essence, it would truly depend on the nature of the suit. If it's something that you guys are looking to recoup a loss for because there was obviously a loss of financial loss as a result of a theft, that it would fall into the crime side of in the insurance world. Whereas if you're being sued for a breach in your professional service, then obviously it would fall into the E&O side of things.
Got it. Okay.
That was great. Thank you, Cole.
Yeah, absolutely, of course.
Awesome. Thank you so much.
Yeah, absolutely. Any other questions, Joshua?
No, that's it for me. Thank you.
Awesome. Well, actually,
right.
I appreciate you jogging my memory as well, because walking through claim scenarios as well. I mean, again, if we have some time here, figured it might actually be helpful to also walk through some other kind of claim scenarios that actual D&O coverage can protect you from. Obviously, cyber is a little bit more straightforward. I know we walked through that secondary slide as well. For cyber, talking about obviously you can think about it, any type of cyber incident that could happen. You see it in the news, week in and week out. Whereas D&O, you might see them in the news, but you don't actually think, wow, that's going to be a D&O claim. And I'm sorry if I just poisoned all your guys' minds, and now you're going to be looking at headlines and thinking, oh, well, that's a D&O claim against that company, that some director's getting sacked over there, right? So, but that being said, if it's helpful to also walk through a few of these, you know, uh, very, very common scenarios that do result in D&O claims, which D&O coverage will step up to protect you guys from, will be something like, again, the four main buckets are shareholder suits, which I know we did talk about, competitor suits, which we also talked about. Let's say you're, bringing over, a new director or building out your team, and there's that, trade secret suit, or you guys are engaging in anti-competitive practices or, unfair business practices. Again, that's kind of that competitor lawsuit bucket. Customer suits, obviously, if the customer thinks that you guys are, not engaging in, fair business practices or mismanaging, customer funds or things like that, obviously that's the third bucket. And then fourth is that regulatory investigations or actions, could be non-compliance with certain regulations or governing bodies. Again, just because of the area up here in Boston, I'll touch on things like financial institutions as well as, you know, our healthcare or health tech clients, where there are pretty stringent, the industries that they exist in, there's pretty stringent regulations and governing bodies that they, obviously have to adhere to. And if, directors and officers are seen as not adhering to those or not in compliance with those laws, obviously, D&O will step up to protect and vet, the management team from investigation into the management team for those. Similarly, negligence on the part of said directors and officers to detect misconduct by the organization. Again, if there's a lawsuit alleging that there's negligence, on behalf of the directors, that will also be kind of covered as well. Again, keeping in the same train of thought with these kind of regulatory or governing claims. Obviously, you have things like securities actions or negligence on or a breach of trust and fiduciary duty. All of these kinds of things go along with similarly, like we already talked about, the misrepresentations, right? Any kind of misrepresentation that you guys are making in kind of speaking with your investors. So again, not to throw it all on you at the end, but I figured it would be helpful just to walk through a few different claim scenarios that we often see from a D&O perspective.
Thank you, Cole. So we're coming to the end of the webinar here, so we just wanted to leave you guys with a couple quick tips before we head out. One is just understanding your risks. I think Joshua did a great job of bringing up some more tricky things that hey, would this be covered under this, or how would this work? Those are really good questions. So just thinking about what your risk and having having a partner that you can ask those questions to and say, hey, that this is what's going on, and knowing that you're gonna get an open and honest response. It's not a sell process, which leads us to the second point here is matching the pace of your business. if you're not going to be doing something for 6 months, you don't need that policy today. Like you should be working with a partner that's really kind of building this roadmap for you and giving you these milestones that you'll hit. And when this happens, you'll need to increase your coverage from 1 million to 2 million. Or when this happens, then this is when you should be starting your D&O insurance. Or this is when we'll look into implementing a cyber policy for you. But we're very educational based at Founder Shield, hence why we do these type of webinars. It's really important that whoever you choose, somebody that can actually walk with you and show you what's going on, and instead of just, it's great to have a quote in 10 minutes, but it may not be actually meeting your needs, and being able to look at two policies and what is the difference between these two, and why would I prefer one over the other. It's really important, and that leads into the final. It's is it going to pay out when it should? If you have a crypto company and it has exclusions, regarding e-currency, that is a huge problem. That means you're just buying a policy to have a policy, and that's never going to pay out for you. So you want to have something that, if something does go wrong, that you're going to be able to recover the money, and a team of people behind you that are going to, make that process easier for you. Because, I don't think that, from my experience at least, not all founders are super up to date on insurance, and some may have previously been a lawyer, but I think it's really helpful just to have somebody that is going to go at it with you side by side. So we were super excited to have this time with you all today. Thank you to Lauren, Patty from Jumpstart, Freddie. We appreciate you having us. Nicole, thanks for letting me poke at you today. It's been
Of course,
been great, man.
I mean, echoing Josh, thank you guys all for letting us join today, and feel free. But on the slide here, all of our contact info is, obviously here. So feel free to reach out with us with any questions, whether it's just a high level, hey, we already have coverage. What do you guys think of this? Is this one of those ones that we should, is misclassified and isn't actually going to protect us? Or, hey, we're considering fundraising, and what do we need, right? That's what we're here for. Whether it's just a high level conversation, and, the actual coverage need is 6-8 months down the line. That's what we're here for. Is our job is to, actually, stay awake at night and worrying about the risks so that you guys don't have to. So,
yeah, and you guys all get a discount with Founder Shield, so we're trying to make it more affordable as well. We know it's really important at the start of your journey, so we want to help as much as possible.
Amazing. Yeah, thank you guys so much. It's really generous of Josh and Cole to provide their contact information so you guys can get in touch with them directly. And of course, you can go to Founder Shield website to investigate policies a little further. So really quickly, I just want to wrap up. We always have more webinars coming up the third Wednesday of every month, including people, process, and tools clarifying your talent strategy, targeted at tech companies like you folks on June 12th, and common legal missteps of tech startups on July 24th. You can review our webinars and other events at jumpstartinc.org/events. At the end of today's session and in a follow-up email, you'll receive a brief survey. We appreciate your feedback. It allows us to continue to bring in experts and entrepreneurs to teach valuable lessons like these. So again, Josh, Cole, Founder Shield in general, thank you so much for talking to us about coverage and options today. And I hope you all have a wonderful afternoon.
Thanks, everyone.
Thanks, guys. Appreciate it.